I'm Chris Preston,
And I'm Brad Simmerman.
and welcome to Street Check, a weekly podcast about investing, the market, and stocks brought to you by Cabot Wealth Network, which has been in business of bringing people the best investment advice for the past 50 years, 50 plus years since 1970. Today, we are going to talk about the debt ceiling. What else? As we're right on the precipice of it, it may be a deal while we're talking here today. What comes after the debt ceiling or after a debt deal is done, presuming it does get done? Will the Fed and inflation creep back into the mix? And then we're also going to talk about Nvidia's earnings and the spike in artificial intelligence lately and where we see that going in the future. And we will also have on a guest today, Cabot, a microcap insider analyst, Rich Howe, who's a microcap expert and is an expert also on spin-offs and value investing, and he's going to talk about a lot of things and why he likes microcaps as a hedge against large caps. But first, Brad, you are up with our Defend the Take segment today. Your take that you're going to defend today, for which you have 90 seconds, is that the early year outperformance in big tech is now over. Go.
Okay, as a rule, we don't call bottoms and tops, right? It's sort of a fool's endeavor, but I just want to highlight some statistics about how narrow the rally has been. Like the Nasdaq's up 20% in the first 5 months. Andy Crowder of Cabot Options Institute actually just wrote that the Nasdaq 100's had its best performance in the last 20 years to start this year. But that's all being driven by big tech, right? So these statistics are from a JP Morgan note from the end of April. The two largest stocks in the S&P 500 were 13.4% of the index. That put that in the 99.7th percentile. And the 10 largest stocks in the SPX were 28.7% of the index. That's 96.1 percentile as far as being disproportionately heavy. So I don't think that there's no rally in tech anymore. I think that the dueling narratives are either tech leads us higher or tech slows down and the rest of the market catches up. I don't know when the rally's when it's gonna really get legs, but it feels like this disproportionate outperformance from the big tech, the safe haven names, the FANGs, that has to be coming to an end soon. And I think that we're going to start seeing those slow down as we head into the summer and as maybe other segments of the economy pick up steam.
All right. You with a few seconds to spare, you did it.
Bro.
Yeah, bro. You're getting used to it. Yeah, I agree. It's funny. Even our growth investors, and Rich can maybe attest to this later once he's on, have been all you hear, especially from Mike Santolo, who runs our Cabot Growth Investor and Cabot Top 10 Trader newsletters, is growth stocks are just stuck in the mud now. They're not doing anything. But if you just looked at the Nasdaq, up 20% year to date, and now at new highs, even up against the debt ceiling. It's all being driven by the stocks you're describing, large, big tech, mega caps.
Yeah, I mean, we've been talking about it, right? It's like it's been the most obvious trade all year. Yeah. That doesn't mean it can't be profitable or you can't ride the coattails of it, but it's certainly been obvious. And I mean, I feel like we all sort of forgot the lesson of obvious trades from the metaverse hype cycle, and we'll get into it more when we talk Nvidia's earnings, but the valuations are just getting untenable, and I think that this rally has to slow down and sort of let reality catch up to it a little bit.
Yep. Yeah, agreed. Okay, let's move on to our big three. Number one is, of course, the debt ceiling. As we speak, there's no deal, I don't think. According to Reuters, though, as of last night, closing in on a deal, 2-year deal. Goldman Sachs, also said something similar. They expect that there might be a deal as early as later today or possibly tomorrow, with a vote in the House coming on Tuesday or Wednesday, and then on to the Senate, which would that would meet the deadline. Sounds like we're going to get a deal. It's funny, when we put this on the rundown a day or two ago, we didn't know we would be talking. This would be a dire conversation. Like, are we going to hit the debt ceiling? Is there going to be no deal? But now it feels, I wouldn't say it's formality yet, but there's a lot of optimism, and that's reflected in the market the last couple of days.
Yeah, definitely. There's a couple of interesting data points, right? So Fitch put, I think it was Fitch, it might have been another agency, put the U.S. on watch for at risk of downgrade.
It was Fitch,
Moody's came out and basically said we didn't, we are not putting the U.S. At a threat to be downgraded for the debt rating because we think a deal is getting done. We're seeing reports that two sides are $70 billion or so apart. I also saw a headline that the Fed, the Treasury, is planning a $161 billion short-term Treasury auction that would be for securities maturing on June 1st, which is the ostensible deadline date. And they had previously come out and said that they wouldn't schedule auctions if they couldn't project where the funding comes from. So I think that June 1st date is actually a little bit softer than people are maybe afraid of. Like, look, it's a cataclysm. If the U.S. defaults, who knows? I don't even want to speculate on it. It would be absolutely terrible. But it does seem like what we were talking about last week, where as long as we're getting these sort of positive breadcrumbs and getting the sense that there's actually movement happening and that a deal's going to get done, we'll be okay.
Yeah, and let's hope that this conversation isn't, comical in a matter of
whistling past the graveyard, right?
Or days. Yeah, but it does seem the optimism. And again, that's, markets have been up the last 2 days after the 4 or 5 straight days of down, not in a disastrous way, but you're down 2-3%. And we talked about it before, that the debt ceiling in 2011, July 2011, the last 10 days before a deal was done, stocks were down 4 or 5% and then kept going down after. There's some other issues going on there, but it could have been, the longer it went without any optimism, the further stocks were going to fall. So just the fact that we're even close to a deal is encouraging news.
Yeah, I think the political climate then was a little bit different too, where that was right on the heels of the sort of Tea Party Republican segment gaining control. So they had sort of more muscle to exercise than the recalcitrant Republican holdouts that are sort of fighting this debt ceiling thing. I'm going to take 1 second to just talk minor politics. The one thing that really gets frustrating to me is you have opposing viewpoints that once they are in power, they act as if they can govern the country without having to work with anybody else.
Yeah.
And that's just not how things operate. I think the adults are sort of in the room right now and are like, all right, yes, we want all of the entitlements, and yes, we want to cut spending, but we're going to have to come to a compromise. So if the adults are in the room, great. I don't know. I don't want to dive too deep into it.
Yeah, no, hopefully it seems like that's what's happening, and seems like hopefully we'll have a deal in place, at least, well, we have to, before we have our next podcast next Friday. Which leads me to number 2 in our big 3. What's next after the debt ceiling? So we've had a year plus of inflation / Fed rate hike angst, which really sort of crescendoed in the last few months prior to the debt ceiling. A few weeks ago, we said, all right, debt ceiling is going to take center stage now that it appears the Fed is going to pause rate hikes with inflation coming down. But as of today, and this is again another topic that has sort of evolved in the last 24 hours since we put it on the rundown. PCE report came in at 4.7% in April, up from 4.6% expected. 4.6% also in March, key measure of inflation price index. So now, according to CME Group, investors, as of this moment, think there's a 58% chance of another 25 basis point rate hike next month. Is this just, if the debt deal gets done, does Fed just return to center stage?
Yeah, it has to. The market was pricing in expectations of a rate cut. I know Bruce Kaiser of Cabot Value Investor has been banging this drum for a while, and I've been banging it too. So the Fed is saying higher for longer, higher for longer. We're going to be data dependent. I wouldn't be stunned if we see more rate increases. So whether that's the next thing, though, yeah. Like, what other catalyst are we going to get between now and say next earnings season when we can actually start seeing some of this AI hype priced into company earnings, where we can see how these other sort of non-tech companies are performing? I don't see anything else until we get to next earnings season that's going to be a big catalyst. It would be great if the Fed was just out of the way and it was no longer a concern, but that doesn't. I mean, it's reality on reality's terms, right? Like, the inflation is not allowing them to not be a factor.
Yeah. It'll depend, I'm sure, on what that inflation number is. My defend the take a few weeks ago, as some people may have seen, heard, was that there will be no movement in the rates at all. They'll be stuck at 5.25% for the rest of the year. I'm sticking to that, but it doesn't mean that fears of another rate hike aren't starting to bubble to the surface again in a way that they weren't, maybe even a few days ago.
Yeah, it's tough. It's sort of tough to play out what effect that's going to have on the market, though. With like, institutions are on the sideline. There's a reason that the obvious trade has been working, and that's because everybody's making it and everybody's looking for some returns somewhere. So the obvious and easiest way to get those is pile into big tech, nice and safe, still growing. Now pile into AI, right? Which we forgot the metaverse lessons. I mean, like, it takes a while for, okay, AI could be transformational. It could add trillions to the economy over the next 10 years.
You want to just transition to number 3? That's our AI is our number 3 topic. Yeah.
Yeah, let's do that. All right. Yeah. So Nvidia earnings came out. They reported a blowout quarter. Stock traded 28% higher, 26% higher, something like that. After they reported, lifted to the NASDAQ 1.7% on the day. Nvidia trading on that day at 220 times trailing earnings. That's astronomical. There's the only time, and I was telling you this before the record, the only time that it's appropriate to invest in a company that's trading at 220 times trailing earnings is if it's the only company in that segment of the economy. Like, if Nvidia was the only microchip company and we were in the economy that we're in now, okay, yeah, buy it up to whatever. The valuation doesn't matter. It's the only player, but that's not the case. There's competitors, there's other moats. I mean, look at a company like Taiwan Semi. They do all the fabs. Nvidia does the design work, but the fabrication is TSM. That's the picks and shovels play on it. But some of these AI valuations, and we saw it with last earnings season too, right? Like 75% of earnings reports mentioned AI. Yep. It's got all the hallmarks of the hype cycle. And I think people that are chasing these names now are likely to get burned.
AI is the new inflation or recession in terms of mentions during earnings reports, it seems, which is a good, rather be mentioning something positive. Just to add to your point, that it's not just Nvidia, Marvell Technology, MRVL, is up 27% this morning after they said that they believe that their AI revenues could double in the next year. Microsoft is having, as part of that mega cap explosion this year, primarily because of its AI, because of ChatGPT and Bing. so the AI is lifting all boats right now, and it's nice that there's something lift. There's boats that are lifting in any segment, because that's, other than oil last year, it's
Yeah.
not something we really saw. So that's a positive. Do we think, are we at a peak in AI perception, or do you think there's just infinite growth ahead and we're just scratching the surface?
Well, so the countervailing sort of thought around the AI stuff is that it could also be cataclysmic.
Yeah.
Bill Gates came out saying the first company to release an AI personal assistant will be the death of Amazon. And somebody else, it might have been Musk, said it would be the death of Google, right? Like if I have a digital assistant, I don't need to search anything. I just ask the digital assistant. I don't need to order through Amazon because I can trust my digital assistant will find the cheapest price available on the entire internet and place the order for me with like the highest rating. So a lot of these, are we going to be standing here in 10 years like looking around at a wasteland of fallen tech companies and like just Google is left, like the Taco Bell fast food wars and Demolition Man, where the only one can survive? Maybe. I mean, it's not like the Feds have been busting trusts too much lately, although there does seem to be more of an appetite for it. um, I wrote something, I don't know, 6 months ago. It was like, all right, well, who's the next? What AI company is going to be the next Google? And my pitch was Google is going to be the next Google, right? It costs hundreds of millions of dollars to run all the AI search stuff. It's really tech intensive. You need a ton of server capacity, and you just need to be able to throw money at it until you can monetize it and until the tech reaches sort of a tipping point. Um, you and I listen to Plain English, different podcast. Derek Thompson, excellent host. He was commenting that a lot of what people seem to be doing with AI now is wasting time. Right? You're like, okay, well,
Right. Yeah, I heard that. Yep.
I'm gonna go into Chat GPT and get it to give me a recipe or write a story in the form of Edgar Allan Poe or whatever. But we need to see that translate into actual economic growth that's driving company performance, which gets back to what I was saying about not being able to see some of these AI catalysts until we get a few more quarters. We're going to need to see how it plays out in the earnings reports. So is the hype cycle over? Like, is tech topped? No, I think there's still room to run if the market rallies, but these valuations are these are 2000.com crash level
Yep.
valuations for some of these companies. So I I mean, yeah, I wouldn't have been buying in 2000 or 2001. I hope, right?
Yeah. Yeah, and good reference to Demolition Man there. I don't think I heard that movie mentioned in about 25 years.
Great
Speaking of
film.
Demolition Man, let's bring in Rich Howe, our guest for our guest for today. Um, what's
Chief
that?
analyst, Cabot Microcap Insider, specializes in special situations, spinoffs, negative enterprise value stocks, those little market quirks that sort of disprove efficient market hypothesis. Uh, how are you doing, Rich?
Hey, good. Thanks for having me, guys. Good to be on.
So, Rich, we were talking about mega caps and how we think that maybe at least at a short-term peak. Well, that's where you're a perfect guest today, because you recommend the opposite kind of stocks. You recommend not only micro caps, but also you do it you take a value approach to microcap investing. Can you just talk about your approach and what you're looking for when identifying microcaps that have growth potential, but also are selling at value prices?
Of course, yeah. So before I do that, I just want to chime in on the whole AI hype
Oh
cycle
yeah, please do. Yeah.
because I have a good data point. So I cover microcaps, so those are my favorite type of stocks. And so one microcap today, the name is Onfolio. The ticker is ONFO, I believe. But similar to what you guys were just talking about, they just put out a press release about some AI tool that they're rolling out, and the stock is up 100%. It has 5 million shares outstanding, And today it's a little bit past noon when we're recording this, 66 million shares have traded of this company. So it's, I mean, that is just like the telltale sign of froth. So while I was listening to your intro, I went on Schwab to see if I could short any shares. And of course, none are available. But I think an interesting strategy would be to just like have some sort of alert, who's coming out with a press release with AI in it, see if it's a disproportionate reaction, and then quickly short those shares before the market reacts. But in terms of microcaps, and
Sorry,
I agree.
Rich,
Or, yeah, go for
I
it.
gotta piggyback. I gotta piggyback on that. So I want to give listeners a little bit of perspective around what a company doing a press release that says AI tools could mean. If you subscribe to ChatGPT and build an API call that just sends chat requests to ChatGPT, where essentially you're just white papering it, you have launched an AI tool at the cost of about $20 a month, and it doesn't deliver anything. So when we talk about froth and hype cycle, we're talking vaporware. We're talking companies that are keyword jamming AI into their reports for the hope of getting on somebody's radar, where the tool, the fundamental strength of the tool isn't evidence in the earnings yet. It's not evidence in the company. They're just adding AI to a press release and probably paying $20 a month for ChatGPT. So that, I just wanted to set that sort of baseline for what some of this froth leads to.
No, that's perfect. That's a perfect example. And I think AI is cool. I mean, I've used ChatGPT, as probably everybody has, and it's super cool. And I think it's, definitely transformational. But I think there's a lot of companies that there's a lot of froth there, Brad, as you just mentioned. And then the other thing, and before talking about what I like about microcaps and the kind of stocks that I'm looking for, this is actually a perfect example of what not to look for in the microcap world. So generally, if you have a company that is very promotional and is coming out with a new press release every 6 months, which with whatever is hot, so it could be cryptocurrencies, give or over the past couple of years, cannabis when cannabis was hot, or AI, or anything that is basically hot. If a company is coming out with these press releases, what you'll look for is typically what these companies will do is they'll come out with these press releases, the stock will jump 50%, 100%, and then they'll issue a bunch of new shares, and that'll fund their operations for the next year or so. So those are the type of companies that are the ones to avoid. And I do love the microcap space, but there's a ton of, I wouldn't say fraud, but actors that you want to be wary of. And so if a company has a ton of shares outstanding, or if you just look at their recent press releases and you just see a ton of press releases with all sorts of new stuff, that's a pretty good indicator of what to avoid.
Especially if there's a pivot in the business model. I remember
Exactly.
an online gaming company, penny stock in like 07, 08, changed its name to Lithium Exploration Group when lithium was taking off the first time. And it did exactly what you're talking about. It ran up to like $8 a share. It doubled and doubled. And then there was one guy in one office building in Scottsdale. Like they didn't have a company. They didn't have the actual thing that they were supposed to be doing. So it's funny that you bring that up.
Yeah, no, I forgot lithium. Lithium was a perfect example, or EVs, right? EVs during the pandemic when Tesla was going crazy. But the things that I look for. So first of all, stepping back, microcaps I think are interesting because generally, not every year, but generally over the long term, they do quite well. So I think the latest statistics that I've looked at over the long term is microcaps generate about a 16% annual return, annual CAGR, going back, call it 80 years. And then large cap stocks are great too, and there's lower risk, there's less volatility, but on average they generate about 9% returns, which is great. But the big reason why I'm interested in microcaps is because you do have the potential to generate excess returns. So that's what I like. And then in terms of what I'm kind of looking for, so I don't like to just buy cheap stocks. Like I want growth stocks too, but I don't want to pay 200 times earnings, like for Nvidia, or even 20 or 30 times earnings. Like I want to buy a stock that is growing really well, but is trading at a cheap price. And you can't find that generally speaking, in the large cap world. It doesn't exist. Now, that doesn't mean that you can't make a ton of money in the large cap world. Look at Tesla or Apple or Amazon, trillion-dollar stocks, and maybe Nvidia will be the next trillion-dollar stock. But it's just not the game that I choose to focus on. So I'll give you an example. There's a company called P10 Holdings, which is a recommendation in Cabot Microcap Insider. It was a microcap when we initially started investing in it and bought it. It basically was a NOL shell. So they had a bunch of net operating losses that they can use to offset future taxable income. So some really smart operators basically got control of this company and ended up buying some private equity management companies. And they've built up the business. When we first invested, the stock was trading at about 4 times or 5 times free cash flow, but they were growing at like 20% per year. So it looked really attractive. Now the stock has appreciated a ton. It's up, over 200% since when we first got involved, but it still looks relatively cheap. It's growing, 20 to 25% per year, but it's only trading at 13 times free cash flow. So the valuation has expanded, but it still looks cheap relative to the growth perspective. And that's really what I'm looking for. I'm looking for stocks that can grow, but you're not really paying for that growth yet.
Right. And Rich, you mentioned, the froth and we mentioned the froth and mega or large caps right now and why microcaps are more attractive. I think you mentioned so you and I you did a webinar last week for some of our audience and talked about, I think I asked you on the webinar, where do you see the market going the rest of the year? You said you thought down, and by market, I meant S&P. You thought down. I imagine you see microcaps having a much different rest of the year, as opposed to where you think large caps are going.
Yeah, and to be clear, I don't know where the market's going.
Right,
I just think there, we have the potential for a pullback. Like I don't think the S&P is necessarily going to see new lows, but I think it could finish kind of flat to downish for the year. Just looking at valuations, headwinds to the economy, and all sorts of things like that. But in terms of microcaps, yeah, so I think microcaps in contrast to large caps look pretty attractive. So I think since the February highs of the market, the S&P, I think is flat or maybe down a couple percent, but microcaps are down like 20%. And I saw that statistic fairly recently, and it was reassuring because, the stocks that I'm invested in, some of the stocks that I'm recommending, it's like the market is bouncing off and you're seeing all this positive news on the AI front. And yet it seems like microcaps aren't really doing anything. And so it makes sense. Valuations across the board are not aggressive in terms of the microcap world. You're seeing very good growth potential. And then you're also seeing, historically low valuations. So again, it's hard to know, whether microcaps, kind of the index or the segment of the market known as microcaps will finish up from here. But I just know, my main focus is just trying to find individual ideas that look attractive on a bottom-up perspective. And I'm finding a ton of those these days. And so that's encouraging to me, right? Usually when the market seems expensive, it's kind of hard to find attractive stocks that look attractive and, like they're growing, but also have cheap valuations. Right now, I'm seeing a lot of those opportunities and finding no problem at all finding new stocks to recommend and new stocks to buy. And so that leads me to believe that if you're buying right now, microcaps, it's probably a good setup over the next year or two.
In the sector, I know at least one of the sectors you've been focused on, because it was the focus of your webinar last week, is biotech. I imagine that's where a lot of the opportunities you're finding are from.
Yeah, 100%. So biotech was in a little bit of a bubble during COVID when all the biotech stocks, there were Moderna and all the vaccine stocks were coming out with new vaccines, and the market was really going crazy. And that was another kind of telltale sign. A lot of microcap healthcare companies were coming out with press releases. Oh, we have a COVID XYZ. So that's just like another version of the same hype cycle that you want to avoid if a company's pivoting and all of a sudden is turning into a COVID booster company. Probably not a good sign for the long-term outlook for that company. But yeah, so since 2001, I think the biotech index peaked in February of 2001. since then. It's been over 2 years. Historically, if you look at biotech bear markets, the biotech market is down still, despite it's come back about 20% from its lows, but it's still down about 50% from its all-time highs over 2 years ago. And we're getting to a point where there are biotech stocks, that are trading at negative enterprise values. And so what that basically means is if the company has more cash on its balance sheet than its market cap. So say you have a company with a market cap of $50 million, it could have $100 million of cash on its balance sheet and no debt. In other words, you could buy the company, shut it down completely, and have 50 million bucks in your pocket just for basically shutting down the company. Now, that's a little bit overly simplistic. You would have to liquidate the company. There would probably be some closing costs, but it's generally a good sign when a lot of biotech companies are trading at negative enterprise values. And today, a record number of companies are trading at negative enterprise values. And then the other really encouraging news is that these biotech companies, they were burning a lot of cash. They've announced a lot of restructurings, and they've announced that they are either considering winding down or selling assets or merging with another private biotech company that wants to go public. So yeah, I think biotechs as a sector look pretty interesting at this point, especially in the microcap space.
So is it just, are you just attributing it to level of uncertainty, right? Biotechs burn through cash. They don't produce any kind of returns until they're either taken public or until they're either monetized by somebody else or they're acquired. That tends to be how the biotechs shake out. So is it just the lack of business activity, right? Slower IPOs, SPACs are basically gone, and maybe tightening lending that's adding some uncertainty to the biotech microcap space?
Yeah, exactly. And so I'm not a healthcare expert at all, so I really don't have much insight into any of the pipelines. I try to look into each individual biotech, even the ones trading at negative enterprise values, and get a sense if there's any value in the pipeline. And right now, the market is saying there's not. Usually there could be value if a company has a phase 3 drug, so pretty close to the market, less value if it's phase 2, not much value if it's phase 1. A lot of these biotech companies have either phase 1 or phase 2 trials, but like you said, they're burning a bunch of cash. And I think just the tolerance for companies that are burning cash right now is pretty much zero in the market. Yeah. And like you said, there's very few, there's no SPACs. The SPACs are gone. The IPOs, there's very few IPOs right now, especially in the biotech world. And an interesting data point, the contrast to that is that large cap pharma just has billions and billions of dollars just sitting on their balance sheet. And they also, I talked about this in the webinar, but if you look at the cash that the large cap pharmas have, it's actually greater than the entire market cap of small and mid cap biotech. So they could essentially buy the entire index today with the cash on their balance sheet. So it just goes to show, and they are starting to announce deals. And so I think that's part of the reason why the biotech index has started to perk up a bit. And then the other important point that I wanted to highlight is that M&A activity there's been more M&A activity than IPOs. And that was the case last year, and that was the case this year. And that's typically a good sign. So the last time we saw a couple of years where there was more M&A activity in biotech world than IPOs, the biotech index was up 100%, looking 12 months forward. So I'm not saying that's going to happen by any means, but I'm just saying that there's a lot of signs in the market that now is probably a decent time to be looking at biotech stocks. And then the other thing that I like to do is take a basket approach, because you never really know. You could buy a negative enterprise value stock, and those should do well in aggregate. But any individual negative enterprise value stock or biotech, you really don't know how it's going to do. So I think it's smart to kind of take a basket approach with these biotechs, just because it is all, it's very asymmetric. It's either going to, work. It's binary. It's either going to work or it's not going to work. And so, I think the whole sector is probably pretty attractive, but it's good to be diversified, especially in the biotech world.
Rich, last question, and it's sort of going to double as a plug for your newsletter, Cabot Microcap Insider. you, I think, are the only Cabot analysts, because of just the nature of the companies you cover, who regularly talk to the CEOs of the companies that you're recommending. How big a part of that is that something you do before recommending a stock, after, during, or all of the above? Just explain your approach with that.
Yeah, definitely. Yeah. So that is one of the benefits. The benefits of microcaps are, one, they tend to outperform. So that's obviously what we all want. The other thing is they're simpler to understand. So generally it's just one business line. So looking at Microsoft or even Nvidia and trying to understand, all the different divisions and what underlying demand is going to be, and then having the opinion that you're smarter than the hundreds of other, Harvard MBAs that are looking at the same stock. It's just a much easier, simpler game to play. And then the other really nice thing is that you can talk to management. So obviously you're not going to be able to talk to CEO of Apple or Elon Musk at Tesla or Twitter or anything like that. But in the microcap world, most times you will be able to talk to the CEO, the CFO, or the chief investment officer, somebody who's very high up in the company and can answer your questions directly. Just before getting on this call, NXDT, Next Point Diversified REIT is a name that I've been looking at and have invested in. And I was just talking to the chief investment officer, just running through some recent questions from the Q1 press release. So it's incredibly helpful to me to be able to have that management access. And more often than not, they're very happy to talk to you. They really appreciate you covering the stock. It's pretty hard to get a sell side analyst to cover a microcap stock. That's another reason why microcap stocks are interesting, because there's fewer people looking at them. I won't be able to, generally I want to talk to the management team or the company before I recommend it or before I invest in it. There's going to be certain situations where I just see an opportunity that looks just so good, so compelling, that I'm just going to recommend it before kind of doing confirmatory work with the management team. Like a perfect example was BBX Capital. It was a spinoff and it was a microcap, and it was just mispriced in the market. It was trading at about 50% of cash on its balance sheet, but they also had a profitable real estate business and a couple other profitable segments. And so that was like, I didn't even need to talk to management. I was just like, okay, this is pretty compelling. I'm just going to jump on it. But more often than not, I'm trying to have a conversation with the company to just go over my assumptions, make sure that I'm not missing anything.
Well, thanks for that, Rich. And yeah, like we said, for people interested in subscribing to Rich's Cabot Microcap Insider Service, it's on the advisory page on the cabotwealth.com website if you want to check it out, a premium advisory page. And Brad, any last questions for Rich before we sign off?
No, Rich is doing the sort of hard work of investing in microcaps, is filtering out the froth and identifying the actual value. And Rich is doing the hard work there. So if you think you are maybe interested in microcaps, give it a look, trial subscription, etc. Because he really does do the deep dive and do all that sell side analyst research that you can't find anywhere else, really. Like you said, it's tough to cover.
Yeah. Yeah, Rich, thanks for joining us. And thanks everyone for tuning in to this week's episode of Street Check. We'll be back next Friday. Our guest will be Andy Crowder, who is one of our resident options experts. So see you then. And as always, give us a subscribe, a like, 5-star rating. It all helps get the podcast up and running. So for Brad and our producer, Madison Robertson, and for Rich, we will see you next week on Street Check.